All right, so welcome. Let's see here. All right, so welcome for the live stream. We are going to get started here real quick. I'm going to chat a little bit today about some different option trades and things you could do and look at in different kind of market conditions here as we kind of get going. And we'll just kind of go ahead and answer some questions as well. I'd like to approach this a little bit more from a long investing standpoint. I know that some people are into shorting, and that's great, but the majority of people are long investors. So we'll kind of chat a little bit from that perspective. If you're a little more advanced or you do some shorting, fantastic, great, and you can kind of ramp that up a little bit more to the next level. So, hey, Kevin, welcome. Good morning from Lakeland. Should be nice and warm there. Okay, so let's kick things off here. We're going to go, I'm going to hop onto the charts here real quick. We'll do some stuff about the news, not that it really matters that much. And then we'll look at some option trades and positions. I've got a little bit of time here. I got to go actually to a dentist appointment later on and then get some stuff looked at. And then I'll sign off after that. So let's go. Before we do, keep in mind, no recommendations here, just some insight. And then we'll check things out. All right, so let's see. Hello, sir. Can you make a video on how to do some short selling? Yeah, short selling, it's not bad, but I would be careful shorting in a market condition like this. Why? Because normally when you short, you actually want to short when things pop. So I'll tell you, like, here's an example of where I shorted not too long ago. We've got XLE, or let's say XLF. Over here, I did a lot of shorting. So when things pop, you don't short when things are down. Most of the time, you don't want to. When you go in and it's popping and you think it's going to roll over because we've popped too much. So you take a look at this move, how long that move in range was. So here's our move in range. Okay, the move in range, we lasted about 1.6 months. So 33 bars. It moved $18. Okay, so we've got about 1.6 months. If that's confusing for you, just try and make it 30 days. It just gives you a much easier, cleaner view. So in 30 days, right about there, we went about 10 points. So you start looking at it, is it overbought? Okay, so you go to, which one were we doing here? I got this other screen. We were doing XLE. We'll go from here and we'll go back about 30 days. Okay, so if you think it's going to pull back 30 days, we're looking at about, yeah, it's about 11 points. Okay, so now you look, okay, in the last 30 days on XLE, here is 30 days. The expected move is actually only about 6, but we moved 11. So they were expecting a $6 move. We moved 11 in 30 days. Granted, there was a longer time frame. So now what you can do is say, okay, in the next, let's say 43 days, I could put on a put spread and I can do something like this. Boom. And I will actually short it right now here for you guys in a paper account. I can buy a put vertical $2 wide. I'm paying about $1.02. Okay. And I already have some contracts in here, as you can kind of see. These are at a loss because I shorted this one before and it's losing. So I can add to it right now. And I'm trying to pay about $1.02. And what you're trying to do now is on a vertical spread is set up a position where, hey, if this thing tanks, you go ahead and set it up. So let's do 5 contracts. Not that I would put it all at once, but I'm showing you, hey, here we go with 5. I'd put it in. And then in the same way, what you can do is put a position on. I'm going to put it in the hedge area. In the same way that you have that spread going, now, once you get in, you go ahead and create a closing order. For example, like the XLF position I did a while back, that one was already taken out for a profit. You can see this XLK, it was short. So here's an XLK position that's worked out. And once you have a position that's short, just to show you what the XLK position looks like, you can see they pull back. Short works, and you already set an order to close it. Now, sometimes I leave these in so that way I have them as teaching tools. But here's an XLK. I shorted as it goes up, right? As it goes up. Now it's going down. You probably would not want to short. Wait till it goes up, then you look to short. So once this gets filled, and it'll take some time, you work the order. You don't usually do 5. You go ahead and you cancel and replace, and you can go ahead and do, you know, maybe something like this, and you start with 1 contract, and you see if that'll get filled. If that gets filled, you know what they're pricing it at. Okay, we'll let that get filled, and once that is done, what we want to do is create a good till cancel order to close it out as well right away. I don't have it in on the XLK, but normally what you would do is go something like this. You select it, analyze closing trade, boom. This one is, sorry, not XLE, XLK. So here we go. And now I've got the 7 contracts. And what you'll do, you could do all 7 right away, or you can actually go with just 1. Rather than all 7, you go 1, and I'll say, hey, I'm going to try to sell this one, this one, this one. So I got 2, 4, 6, and then I'll do another one that'll be 7. So there we go. So we'll do 2 contracts, 2 contracts, 2, 4, 6, 7. And I'll try to sell this one for $2. I'll try to sell this one for $2.02. I'll try to sell this one for, let's say, $2.07. So now you start sending the trigger in. Okay, rejected. Invalid sell price. Why did it not have a sell price? Maybe some order issue. Let's try this one. Because sometimes with the paper platform, yeah, it's not panning out. This one, I'm gonna have to take it to expiration maybe. Maybe there's no pricings on that one. Paper platforms aren't always the best for that kind of stuff. Okay, let's see here. Let's try 1. It should be 197. It's probably not even traded so far in there. Okay, let's go in and push this one a little bit more. You can see at 105, it's still not getting filled. And the problem with markets that are moving very quickly is this bid-ask spread. Here's what you want to watch out for. You got a mid-range and a natural range. If you pay 291, and I see some people that will overpay in these conditions, I usually get coaching sessions, and then people like overpay, and then the next day, like this price is back at 105, but they pay 291. They basically doubled they paid twice. It's kind of like I went to try and buy a pair of shoes for $50, but I ended up paying $100. It's like, no way. So you might have to push the order a little more, but even at $1.15, I'm starting to get to that point where I'm overpaying. But I want to see where the market is. And sometimes in these conditions, you got to let it sit, and it's got to sit. So look, right now, it's trading at $1.04. I'm trying to pay $1.15. I'm trying to overpay, and you're still not getting filled. Okay. Nima asks, how about shorting SPY for more hedging long positions? Yeah, you can. Okay, so if you've got a lot of long positions, like here, I've got a bunch of SPY as well. Just like a regular long investor, you know, I got a lot of stuff that'll be going against me because I'm long delta. So if you've got this, what your objective here is to go ahead and start reducing delta. So if you've got, like for me, I'm doing it in the Qs mostly because I've got, let's say, 100 shares in this portfolio example. Your objective is to take this delta down. That is how you start looking at this. Like, let's say you're going at 100 miles an hour. In this case, I'm going 131 miles an hour. I need to tap on the brake to get back down to 70 miles an hour, maybe. That is the approach. So what are the things you can do to start reducing delta? So if I'm trying to reduce delta here on the SPY, and I've got, you know, a ton of stuff on the SPY here. I know I do. Let's go to this long portfolio section. I've got a bunch of stuff on the SPY. And you're looking at how do I reduce that delta? Now this delta is only 23. If I go to QQQ, I've got some more delta because I've got, you know, 100 on its own from this. How do I start reducing delta? Well, what I could do is try and pause this position first off. There's a couple of ways to do that. So here I've got 83 delta. How do I pause this a little bit? Say, hey, I'm worried Putin's going to do some crazy stuff, or I'm worried about the rest of the world's going to panic. You know, we've got, you know, this crazy Russians, right? I'm Russian, obviously. You got a lot of stuff going on here with the Russian stuff and Kyiv, Ukraine and going on. But if you're like worried about it, let's say I want to just pause my losses at a certain point. What you can do is a couple of things. So let's say here, what would I do? Here's my thought on this Qs. Okay, if I was to say, hey, I want to pause it, I would do a synthetic on it. And I'd say, hey, probably in 36 days, Putin will calm down, the world will calm down. I could say that. Maybe it'll take 43 days. So depending on my duration, like, hey, when do I think things are going to calm down? So what I can do is do like a little synthetic position. I think they call it a combo here. Let me see here. This one and this one, like right here. Let me check this out here real quick. Okay, so you can see right here what I've done is I sell a call and I buy a put. And what this does is invert me 99 shares short, okay? Where I have 100 shares long on the Qs. So if I do this, it pauses my position. So now if the market crashes, my final value does not change. I have flattened my curve. So this is one way of doing it to flatten out your picture. It looks a little weird or funny here. Only because just the way that it works, it's hard to kind of show it on the expiration picture. But if you look at expiration, now I've flatlined my loss. Now my loss is still, 2,700 in this account. But if you think, hey, it's going to keep going down, rather than keep bleeding money, you could say, hey, let me pause for 30 days, wait till the market calms down, and then I will go and reevaluate from there. Do I want to add to that position or not? You could start spreading some of these things out as well. Like you could say, hey, I'll spread this out like this and start, manipulating some of that stuff. And then you get some different kind of curve. So what this does is basically increase or reduce delta. So you can see I've got now a bigger negative delta by spreading that out. So, if I tighten it up, I'm getting back into that 100 level. Okay. So there it is, back to that 100. So if you have more delta, you could do it that way, or you could just get a couple more contracts, but it's kind of a fine way to kind of tweak it a bit, as you could say. So if I want to pause it, I would say, hey, time to pause, right? This is great in portfolio margin accounts. And here, I put it in here, say, hey, I'm ready to pause it, pause that position, let it work, do what it needs to do. And we'll see here in a second if it kind of gets filled. I might have to push it here for the video, but normally you want to be patient with this. That's like a full-fledged pause. Okay, we'll let it work, but that's how you kind of can do it. Hey Sasha, Justin here. Was thinking in such high volatility environment, would entering a calendar diagonal in any circumstances, short term, reduce Vega risk? Yeah, you could. I like let's say calendar bombs personally, but I don't do. It's tough to do them when the market's already down. Usually, you want to do them when the market is up. So when the market is up like this, you put them on, or even here. But if you're thinking like, look, I just want to offset some Vega risk just in case it keeps going down, you could throw a calendar down at lower levels. And here's how you might do it. Actually, I've got a few on my live account. Just let me double check some stuff here over on this other screen. See if everything's kosher. Yeah, so what you can do is basically, let's say I've got a lot of SPY risk and I need to offset the hedge. The way you can do it is, let's say, okay, 30, 40 days, add some Vega. You don't want to go too short because you'll have some price risk, but if you go too long, you'll actually get more volatility risk if the volatility crashes. So you do have to be careful on both ends. So maybe something like a 25-day, 30-day. I mean, you have to choose, but let's say you're just trying to offset some risk. So let's say we're going into about maybe a 20 delta here. I'll put a calendar here. And let's hide all the positions here real quick. So what you're doing is, hey, I'm adding a little bit of Vega right here. Okay, adding some Vega over here. I can put another one over here, and that way if it pulls back, as it's pulling back, then I can slowly start taking those positions off. So I could say, hey, and I've got a lot of contracts on this little quick mini portfolio, but I'll throw a few here. I could throw maybe another one at 400, just in case it doesn't, let's say 410, just in case it doesn't pull back as much. So I'm just kind of spreading it out, and I can say, hey, this expiration I'm going to use as a hedge. A lot of times you want to spread different expirations, as we talked about, different areas, different points. But I could say, hey, that expiration I'm going to use as my hedge. So that way oh, there's our SPY. It got filled. but a lot of the other times, you might just say, hey, I'll manage that duration as the hedge. So now I'm getting some negative delta, I'm getting some positive theta, and I'm getting some extra vega. And now you've got like one, a little bit of the spot, SPX, 1/3 of the SPX really. You could also add in just a tiny bit of diagonal if you want some more stuff, but you can also do it with just more calendars too, just spreading it out maybe at 405. So now you've got, a little bit of a position allocation if we keep pulling back, and you're really risking only about $200 for these 4 or 5 contracts here. And you could start putting them in if you're worried. So yeah, you could do it. I mean, just as a slight hedge. The downside with doing this as a hedge is actually if you overshoot, because I did do some of these the other day, and I've overshot today on a few of them. And if you get a really nasty move, which is pretty significant, you can overshoot. Like this one can actually be like a bad one, and these could work out fine. But that's a little bit of the trade-off, right? It's not as expensive as doing a diagonal, because the other alternative is you could do these in a diagonal sense. So I've got something like, let's say I've got one of these, and I've changed it to a diagonal here. And now what I can do is, let's say I start rotating it like that. I could do a diagonal this way if it really tanks. The 407 is not traded. How about 406? So even just doing a slight diagonal, it can help offset a little extra delta negative and positive vega. And this, at least if it really tanks, it won't burn you. So having 1 or 2 of these mixed in with the other 2 or 3 is a good benefit in that case, I think, because otherwise you can overshoot. But for most average pullbacks, like putting on like calendars like this is nice because you get some extra vega from all the other stuff you're selling. I hope that helps. All right, Daniel asks, reducing delta in front of possible bounce in the market is the inversion problem I still have hard time to manage. Yeah, so right now, I kind of posted this in the Discord, and if you guys are not on the Discord, feel free to join in. But I did a quick trading tip over here where, let me just make it larger here. So there's a couple things you really want to watch in these market conditions. So the first is the bid-ask spread is usually a problem. You saw that with the XLE and XLF. So if I go to the trade and you start looking at putting on a spread, just if you start watching these spreads now, they have become much wider. So limit orders for sure, okay? That's number one. If you look at even SPY that normally, or let's go to QQQ, that's normally 2 pennies wide or so, 1 or 2 pennies. This has now become a 10-cent wide. So all the market makers on the floor love these markets. You know, the guys that I've heard telling stories about it, they're usually making, I don't know, maybe 50 to 100 grand a day just from people putting in market orders and them taking the spread difference. You know, some of them making a lot more depending on the volume and the panic. But what happens is people will pay a market order and it's a 10-cent kind of spread. And they're making a lot. Normally it's a 2-cent wide spread and they're barely making anything. So what you have to really recognize is that if you're dealing with larger stocks like this, 59 to 62, you've got almost a $3 wide difference on the bid-ask spread. You got to be careful with this, right? With these kinds of movements. So that's number one. The second thing is, you know, Daniel talks about the inversion risk. So yeah, so here's the 2 big points I mentioned. Panic can set in right now, which you see a big flush. When you see panic, that's usually a time to nibble, but the problem is you don't know how long that panic will last, because you could nibble, get some relief, and then sell off again. So you have to watch out for a secondary sell-off. You know, it's kind of, you know, that's where you short on the bounce if you're thinking for the secondary sell-off, or it's where you can hedge some of your long positions. But if you're trying to hedge now, then you get that inversion risk. So what happens a lot of times is, let's say you go in and right now you try to protect because you're seeing your account like down. You're like, oh my God, my account's down a lot of money. So you start trying to protect it. And then what happens is like let's say you go in and you go into the SPY right now. So you can't like over freak out about these things. It's like, oh my God, and then calm down, take a chill pill, and then take a step back. So that usually is a first sign of the trade was maybe too big or too much concentrated. It's kind of what we've been talking about in the risk array section right now, this last couple days on the class. If you're starting to over panic, it probably means you concentrated too much in one spot. But here's what happens is that, like, let's say you've got some position on, let's say QQQ, like I've got. Okay, so I've got QQQ, and now I've got my positions here, and you can see, boom, I have paused my position. That means I will not lose more than probably like $100 for the next 30 days, because I've got this insured. And I'm saying, hey, I'm pausing it. But let's say you didn't have this. Let's say you were long stock, okay? Even long calls or just long whatever, verticals, doesn't matter. And you start saying, okay, I'm going to go out 35 right here, 35 days, and I will start selling the 350s. And even though it feels like a 23 delta, it feels pretty good, right? So I got this one, and then let's say I'm selling a vertical. So I try to start protecting this because I'm starting to try to reduce delta. So I've got 100 delta right now, and then I start adding it in. Again, you'll probably want to spread it out, but let's say I'm just trying to cut it real quick. I'm trying to go back down to about 24. If this starts to grind up, this is where the inversion risk happens, where now I put on such a large spread. Like, think about it. I put on a larger spread in a market that's been down in a big way, and now the counter energy can snap it back up right here. And now this spread is at basically, I didn't make money or lose money. I'm just basically breaking even again. And you're kind of just chasing, like, the dog chasing the tail, kind of around and moving back and forth. So this is where the issue lies. So you have to have enough. Let's say you got 100 delta. What you're trying to do is tap on the brakes rather than slam on the brakes. So rather than maybe 17 contracts and I was going 100 miles an hour, let's drop it back down to maybe 64 miles an hour. It's like a fine tuning thing, not so much like a full pause. The time to do the full pause is more like, okay, like if I really do want to pause it, like I'm going on vacation or something, I've got these 100 shares, I need to pause it, or the market's just tanking. Let me just give it breathing room. I'm good with it. Then I want to pause it. And now I'm okay at going up or down. And like, I got a plan for the next 15 days. Let me just let it calm and simmer down. On the other hand, if you're trying to actually just hedge off the risk, you have to hedge off slowly, because now what's going to happen is if it snaps up on you, now you're making back some of those, which is good, but unfortunately these become a bit of a problem. So if you over hedge or over adjust, let's say you even take it down to like I go the opposite effect. I increase my deltas to now a negative from a positive, trying to gauge the other way, which I've done in the past, like for certain things, for a temporary move. Maybe it's going down and I hold it for a couple days. But it's dangerous, because if it snaps up, you've got a long position that now you're losing money on the upside. So can you do it? Can you probably handle it for a week or two? Yeah, you probably could. But you want to be careful of that snap up, because you've got a huge concentration and accelerating deltas that'll come in very quickly. And it's all like right here, obviously right now. But you could mix it in with positions. But the issue is that snap up can be pretty violent. And if you look at some of the charts in the past, just any time, even recently, when you have a big, large down move, the retracement's usually about 50%. We've talked about that in the swing trading class, that a typical retracement can be about 50%. So even here, you can take a look where, this one was even a 61% retracement. We got back into it. So if we here, let's just say we've got an ABCD pattern, maybe we'll get down to 400. I don't know. I mean, it could get pretty nasty. But let's say we get to 400, but then we'll snap up maybe to 430. That is probably when you'd rather short or hedge or adjust or that kind of thing. That's when you want to start looking at those kinds of things. Okay, the risk Ray course is eye-opening for you. Okay, wonderful. Yeah, it's a good class. It's not as a popular topic as you would say for like adjustments or iron condors, but it's an important one. So not everybody would think it's a from the title, it's not a attractive class, but it's an important one for sure. So I'm glad you're enjoying it. Okay, so that's how you would look at kind of these things. Now, if you are short, here's the other thing. There are some people that I have that are more perma bears. And if you're short, you have to watch out for those massive rallies. That's kind of what I've just mentioned. It's because that market can whip up just as much as it goes down and the wall of worries fades. So when things actually just start calming down, you'll start seeing like these things start grinding back up. So what you see right here, like you look at NVIDIA, and I only say that because I've been watching that position closely because I have a bunch of stuff on it in a live account. But look, we snapped down and we're snapping back up very quickly, including bullish volume starting to build. I don't know. Let me just check out some of my other positions real quick. Here, AMD is the same thing, snap down, trying to come back. So I'm not saying it can't continue down, but what you'll see is after a large move down, you see the snap up. And you're seeing a lot of stocks in general, like stuff like PayPal, like it is nasty. But look at this move. So when you have energy here, right, you had the flow of energy going this way. Now you've got just as much, if not more, going the other way. It's trying to create like that, balancing act of weight here, and counteract it. And sometimes with the force, with the gravity, it'll actually snap down stronger. And that's kind of what happens with these markets, as with anything that you watch. And you can see this with, just take your pick on anything that goes up or down very quickly. If we go up too fast, we'll consolidate, go up, consolidate, or pull back. Here's this one, ran up too quick, pulled back, right? So take your pick. Shopify, same thing. This one, running up very, very quick, right? So, and then that's where you get the counteract. Okay. So let me show you a couple more quick things some people like to do in these bearish markets. Is kind of the thought from a long investing perspective, and that's what I want to share here today. Is that a lot of people have been trading, like let's say you're trading Apple, a lot of people's favorite fruit, and you can see it's pretty much, down in a big way today. So it's toast. We're like flying. This is where panic sets in because we've got like gaps down. Now, when you see stuff like this, you kind of have to always take a step back and say, if this is something from a long portfolio standpoint, and you look back to the time frame when you were buying Apple, and I don't know if you were or not, but let's say you were buying Apple, you're looking back into August, September time frame, you're back at those same price levels. Now, the question is did you ever say to yourself in the last 2-3 months, which was way up here, that you liked Apple? If you've ever said that, if you liked it, then in that case, you might still say, well, if you liked it at 170, 175, you probably should like it at 152. I don't know if, Putin's going to confiscate all the Apple iPhones out there, but probably not. So yeah, maybe there's tension, but they're selling Apple because they're panicked, not necessarily because of, a lot of, the Russia thing. Right now, a lot of the Russia thing is driving the market lower. But that people tie themselves to a certain news event. The reality is some people have sell orders in place 30 days earlier to dump the shares because they're trying to buy a house. Some people have sell orders in place 30 days earlier because they need to cash out their investments because they had it with their hedge fund to cash out their investments because they're retiring or because they're whatever. So the reasons pile up is not just one or two reasons. Many people are selling or dumping the stock for hundreds of other reasons. So make sure that your bias doesn't play a role into this. You just because you think it's one thing doesn't mean it is for other people. So everybody's got a different reason. So if you said you like this stock back here, you probably should like it around here. So how do you start nibbling on positions like this? Well, you have to think about it from a, let's say, 30 to 90-day time frame. If you want to allocate more capital longer, you can. But let's say I'm looking at a 90-day window. In the next 90 days, do I think this will be higher than here, than 150 or so, than 160? If you think so, then spread it out in the next 90 days. If you think it'll take about 180 days, then spread your capital around 180 days, okay? But what you want to do is start, okay, so if I got 10 grand, I could start putting in $1,000 at the $150 spot. I'm just going to say $1 just because it's easier for me to write. Okay, so $1. So I put $1 right here, okay, at the 150. If it keeps going down, I'll put another dollar, or $1,000, $1,000. Okay, if it keeps going down, I'll put another dollar. I still got 7 left. The issue with a lot of people is they put in like their $8,000 right there, and then they get choked out at that 150 and they don't have the range. So this is why you've got to have room for, let's say, a 3-month time window or 4-month. Now, if you see it down at 130 and saying, hey, this economy is starting to be really trash, I need to pause. You can pause and then wait and wait and wait a little longer. And now what you're doing is I'm spreading out my capital, just like a long investor, whether you're doing it verticals or diagonals. You're putting a little bit here, you're putting a little here, little here. If it's still going down, wait. Then when you see a little balance, start adding more money. And now here you can add big, like you say, hey, it's stable. I can add a big amount, and then again, another big amount. And now you've kind of averaged that price and allowed the market to digest the sickness and pain. And now, just like you liked it at 150 or 180 in the past, you liked it here, you still like it at 150. And look, you've averaged your price, you've reduced your time risk on here from a long investment standpoint. At the beginning, what you can do is do shorter or smaller deltas. So if I'm doing stuff like Apple right here, let's say I'm going like 85 days, I could do longer duration. That's number one. Another thing you can do is rather than selling verticals, so if you're kind of like selling vertical puts, okay, so you're normally selling vertical puts and you're saying, hey, I sell at a 10 delta. Well, here you're risking $67, or sorry, you're trying to make 67 on 433. Why don't you risk less? Bring it in a little closer, okay? That's number one. We'll bring it in closer. You might say, well, isn't that more risky? Not necessarily, because now you're risking less capital. So now I'm actually risking only $350 if I bring it in closer. And then, look, I still got 6 delta. Well, how do I reduce that delta? Because if it pulls back on me, I'm still risking 345, 350. Well, why don't I now go and kind of do like a bullish iron condor, sell the other side over here, right there, and collect an extra 50 cents. And now I've got myself less delta. I've got 2 delta right here, but I've got a stronger one on the put side over here, and I'm actually only risking 293. Now, if you say, hey, I need more range because I think it's going to go higher, fine, just move this call side strike wider, okay? And now you've got yourself 3 delta. So you went from a 6 delta and you cut it in half to a 3, okay, to $313 at risk versus $345 at risk. I know not a big difference, but when you start talking about, let's say 20 contracts and 20 contracts, okay, you're $6,800 at risk without it, and then you've got $6,100 at risk with the other side. If you really want to be more cautious, just bring it in even, you bring it in tighter. So I could do a 160 and a 165. This is where we get to almost a butterfly. And then what I can do is really just tweak my deltas a little bit like this. And now I've got a 10 delta. So now I'm risking 3,400, okay, rather than without that protection, 6,900. So you can really cut your capital in half when you get really close. And you still got some positive delta and a much stronger theta, but it allows you to be long exposed in kind of this medium. Okay, so that's another way to do it. Another third way I'll show you is, let's say you want to go something like this. What you can do is convert it to a little bit of a back ratio and add like an extra put on the back end. This hedges off the tail end risk, where if we really get a nasty market crash or problem, this will give you that, if this can really crash, at least it'll protect you down to the 100. Like, you never know what'll happen, right? Let's say war breaks out, we bomb everything, they bomb everything, the world starts to end. If that's the case, you just kind of grab a bunker and you don't do anything. But if you're thinking the market will be alive after that, then you could get one extra put to help hedge that off. So that way you're a little smoother over here and, reduce a few of these over here. So this is getting into a little more complex levels. As you can see, I took you from a basic stock kind of thought to a little later, and more evolved situation here. But you can see how you can kind of craft this to still be a long investor. Because if you liked the stock before, you probably should like it now, because it's at a better value. But you have to look at it from a spread your money, spread your capital. That's actually exactly what we're covering right here in this class, in that risk array class. You could check it out. We covered quite a bit of stuff on spreading your cash, and you want to keep thinking about it in that way. Okay, what happens if you put the dollar on the first dip and then the market goes up without you? I would still give time for the things to digest. Remember, the sickness, even if you feel better one day, it may take 2 to 3 days for your body to fully recover. Just create a story for yourself in the real world if you're struggling to understand the concept, that how it applies to trading. So if you got sick one day and the next day you feel better, your body's probably not fully healed. It probably takes a little bit of time for your body to kind of digest everything, heal, and patch things up. So what you want to do is, wait a little bit longer, make sure it proves it to you, and then you can add a little more quicker if you think and believe that things are good. You can accelerate the buying then, but be careful you don't overdo it too quickly, because you don't want to go run a marathon now that you're feeling better. You want to at least stay a little more patient, shall we say, because if you try to run a marathon but you're still sick even though you're feeling better, it's probably not going to do good for you because you still need your rest. Nima says, thanks Sasha for the hedging idea. Could you recreate a combo thingy on SPY? I'm wondering what strike price you choose and how much it costs. Well, yeah, the combo thing is basically an at the money spread, okay? So it's at the money, but you can change strikes. That's much more advanced. I don't like to go too advanced on YouTube videos because there's a lot of people who are new or first time folks. We cover this more in coaching or classes where I can interact with you guys. But really what I did was create a short position, which now that short position is losing, as you can see, $240. And then these Qs, I'm down from the day, obviously $126, but it's just locking my deltas. It's killing my deltas to nothing. So, I could do it. It's called a synthetic. If you want to learn about it, it's called a synthetic. It's 330s. It's right at the, right there at the money right now. And, that's kind of the way I set it up. Okay. So it's just a little more advanced to over discuss it. I shared it with you to open up your eyes, but I wouldn't, recommend it for like everybody to go in and jump on it to say, hey, you got to do a synthetic. Okay. All right. So one of the other things like you can do is if you're just doing those verticals or iron condors, you could just do a back ratio spread the other way. Okay. Let's see. Justin's got to sleep now. Okay. Yeah. Have a good night. Does your options course work on crypto as well? Yeah. Anytime you're doing options, the options apply because they apply to all market conditions because all markets are global. So as long as the option chains has puts and calls, it's all going to be relative. So it's just that, you're trading crypto or you're trading oil or gas. It doesn't matter what you're trading because the options are creating strategies and managing risk, managing the delta time and the volatility implications on it. Okay, so looking at, let's just say we're looking at buying the dip on certain stocks. Like let's say you're into PayPal. I'll show you like kind of one interesting insight here. If we're looking to buy the dip and we've got PayPal, here we go, where are we? How much time do I have? I got a dentist appointment that was scheduled months ago or something. So, okay, so if we're looking to buy the dip on PayPal, let's say you're seeing things crash and you want to buy the dip. Again, I'm approaching it from a long investor standpoint because most people are like long or bullish or buying things. If I want to buy the dip, like you don't know where the bottom is. So how do you buy the dip? I'll show you this back ratio spread real quick. So let's say we're doing PayPal. The first thing you can do is, just like we talked about, selling the put verticals. So here is sell a vertical. Let's see if it'll come up. A little laggy as the stream goes. Okay, so here we go. All right. So if you do this, you have to make sure they're a little closer in, because what we're going to do is we're going to buy some protection. If you buy protection, you need something with sustained value, meaning it needs to be closer. If you get a smaller delta, there's nothing to protect. So this is where you go into like a 95 and maybe a 90, and then you're a little bit more substance, more meat in this premium. Now, you need more contracts as well, because once you add one, it's not going to be able to, you're going to overprotect if you go ahead and add a second one or third one. So here's what I did was I went in, I got a 95 and a 90 spread, and I added 2 extra puts. And that helps hedge off this tail end risk. So now if the stock goes up and it moves to the upside, I'm good. But if it pulls back, at least I have this slower, steeper problem. The downside with this is I make less if it does go up. So I'm trying to make 880, let's say, at expiration. Whereas without it, I would look to make 1720. So almost double. I could make twice as much. But here's the problem. If this stock keeps going down to 80, I'd risk about $1950. So $1,950, I'd be at a loss versus the $3,200 at max loss. So again, think about it, $1,900. Whereas if I add an extra put or 2, I'd be down only $125 if it keeps pulling back. So basically the trade-off here is, look, I won't be able to make as much, but if it pulls back to that $80 level, do I want to be losing about $1,800, $1,600, or do I want to lose about $200? So that's what you're trying to do, is now offset this tail end risk for if it keeps going down. This is how you buy the dip more effectively with options, is that you're putting up a little less capital in that end. So this way you're like, hey, I'm ready to buy the dip. I just don't know when it's going to start going to the upside. Okay, does your option, let's see, throw this gentleman a like on the video. Thanks. Yeah, so anyway, so this is how you kind of start hedging off some of the hedges or the risk. That's one way. Now, this is looking for a credit. There are some people that like to trade this, and this is the last thing I will share with you, because I got a couple of things coming in right now. People wanting to do some coaching things and some other stuff. Let's do the call side of this. So here what we've done is the put side, but let's do a vertical on this end. We're already going a good 43 minutes. Okay. So now what we can do is the same thing on this end. Sorry, I got a little distracted. Wrong button. We'll go in and sell a vertical in the same way. If you're super worried about the market, you can kind of do it this way. And I'm going to get it very close to about 100. And I'm just saying you can do this on the QQQ. I'm just going to use PayPal as an example, though. But you can do this on QQQ, SPY, IWM. Okay. And then what you can do here is the same concept. We'll switch it to a custom, but we'll add an extra call or 2. So now if the market keeps crashing, it's kind of like taking a cheap shot, doing kind of like calls. Like if you like to do calls, this is a cheaper way to play like an upside move without a crazy theta risk. You do have some negative theta, but if the market keeps going down, at least you don't lose everything on a call. Because if I did the calls right here, and I just, let's say, buy calls, buy a single, my problem with buying a single in these conditions is, number one, I've got a positive vega trade, so when it goes up, the vega is going to hurt me. That's one. Number two, I've got a loss of theta. Number three, if it goes down, I lose all of this. This is probably the biggest issue, is I lose $760 to take a shot to the upside. So how do I take a cheap shot to the upside with a back ratio? And you could do it with a butterfly. You could do it with other things. I'm just showing you a back ratio because that's what we were talking about. So I could go ahead and do something like this where I go in and I do a back ratio where now I'm going in and saying, okay, I got a 10 to 14 spread. And now what's happening is if the market keeps crashing and this thing expires, I make still $114. Now, if the market skyrockets and explodes up and everything gets resolved, this is where this can pay off really nicely, because now that snap up can be big. You could be up very quickly. But the trade-off is you're paying for this about $26 a day. Okay. Now, it's not as bad as doing singles. Like, you're still, you're losing some money here on the theta, but it's not as bad or nasty. Now, how can you offset this risk a little bit? So I'm going to show you one more final thing before I sign out, is I could actually sell some puts against it to offset that theta. So if I'm bullish and I think this will explode, now what I can do is go in and start selling, well, let's go into about a 90 because we're kind of close to there. So now I'll do a combination of both. So if we stand still or pull back a bit, I've got now a couple of things to reduce some of my risk on the theta. The problem with doing this is you will get a little bit of this dip in this area. So now if it stands still or pulls back slightly, you're okay here. If it snaps up, you're good. If it pulls back in a big way, here you have a loss. So it's kind of like, what construction do you want to make for yourself? You could do it where if it really crashes, I'd say this is the better approach at a simplistic level. If it crashes, you're okay. If it skyrockets, you're good, but you lose theta. If you want to be a little more advanced about it, you could temporarily put something like this on to slow down the theta. I wouldn't overdo it. You're just trying to kind of cushion it maybe to half. But the downside with this, if it does crash, you do have that risk from the puts you sell in this case. And you can do this on Qs, SPY, IWM, whatever, anything. I'm just using PayPal here as an example. But anyway, that's just another approach. Okay, any other final last quick questions? Because I gotta get going here. Let me know. Market looks like it's stabilizing a little, but remember, you can also get a sell-off again, a secondary round. Maybe they're just pausing for breakfast or bagels and lox and cream cheese. Who knows? Okay, wonderful. All right, you guys have a great day ahead. Be careful, be patient, watch your trades. If you want to join our risk array class, feel free to sign up. You can do that on the Traders Fly site, and well, you can grab a lot of freebies there as well. So I just want to show you some resources. If you're not part of the Discord group, just feel free to join there. I post some tips periodically, not anything like stock trading tips from a, hey, this stock to buy or sell, just some actual logical things to think about in market conditions. And we've got another couple of great classes coming up from market seasons, and we did cover calls, single options, portfolio stuff, and some adjustment things as well recently. So check all those things out if you're interested. They're really in-depth, usually 5 to 10 hours of training. And I hope to see you in another live session in the future. Thanks again. I'll see you next time.